Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, a Bloomberg exclusive. SpaceX targeting an IPO next year. The goal? To raise far beyond $30 billion, the most in history. The valuation? Around $1.5 trillion. Why? Data centers in space. Plus, open, then closed. Meta making a pivot on open source models. We had the Bloomberg deep dive. And reports that DeepSeek smuggled thousands of banned Blackwell chips into China. Nvidia pushes back. Let's get to our top story. It's in the private markets and soon to be public markets. Bloomberg reporting that SpaceX is very much underway, targeting an IPO in mid-2026. They want to raise far north of $30 billion. In terms of dollar raised, that would be the biggest IPO in history. The valuation we're hearing, $1.5 trillion. There's a lot in play here, but my understanding, this is very real. It had an impact in public markets. Some of the names out there in the space sector, particularly EchoStar, that is in talks on licensing spectrum deals with SpaceX, really moving over the course of 2 sessions in reaction to this. I use that as an illustrative example. This is the IPO that all corners of the technology market and the private market have been waiting for. Let's bring in Bloomberg space editor, Eric Johnson. Eric broke this story with me yesterday afternoon. And we'll go back to the basics of what we're reporting, Eric, because there's a lot of data in there. But the main headline, I suppose, beyond the valuation is SpaceX wants to raise north of $30 billion. You and I are getting a sense on why they need that capital.
Ed, great to be here, and congratulations on your scoop and great reporting. Yes, they are. What we're hearing is a $30 billion raise, which, if you look at the history of SpaceX, Musk is known for his grandiose visions. They're building Starship, a colossal rocket, which he expects to put humans on the moon and eventually one day go to Mars. So the money could be used for that. He also has talked about, as you mentioned, the idea of putting data centers in space, harnessing solar power and having a huge amount of computing resources in space. They would need to buy chips to do so the money could be used for that. Of course, the other side of SpaceX is Starlink, the satellite internet business, which has grown substantially over the past few years. So there's a huge portfolio that SpaceX is bringing as they transform space travel.
Eric, we're showing the other part of what we reported, which is, through our reporting, confirmation of this tender or secondary offering that's going on. In other words, SpaceX allowing employees to sell shares, but to do that, you need to set a price, and that gives a valuation. We've now done that reporting. Run us through the numbers that we need to know about this tender. And for me, the important bit here is that this kind of settles valuation ahead of that IPO.
Absolutely. This level sets the market valuation as a precursor to the IPO. But essentially, SpaceX runs biannual tender offers, secondary offerings, where they allow existing shareholders, employees, and others, insiders, to essentially generate liquidity from their piece of SpaceX. And so, as part of that, they set a valuation of $800 billion, which is a record, beating OpenAI's latest tally from October of $500 billion. So making it, once again, the most valuable startup in the world. So this is walking up to that IPO. And of course, as you mentioned, the IPO would be $1.5 trillion, roughly, valuation.
In the private markets, the share price right now is about $421 a share. There is so much left to discuss. I think that a lot of people will say, how expected was this? We've done reporting over a number of years, actually, on the space team, that originally the focus was on spinning off Starlink, right? Because you and I also reported some of the financials for SpaceX in this current year and next year. Starlink right now is really the cash cow for this company.
That's right. They bring in the majority of revenue. They're expected to do so last year. As I said, they've got thousands of satellites in low Earth orbit. It's a booming business, millions of customers. I've flown on many flights around the country that airlines are starting to use Starlink. You're starting to, the customer reviews are favorable. So I think investors are seeing that growth. People, as they have watched this company, they're seeing Musk make these huge promises and then is, iteratively, incrementally delivering on them. So there's a lot to be seen as far as, can he continue the growth of Starlink and also direct to cell. That's another nascent business area that Musk has promised to link regular consumer cell phones with that network of satellites in low Earth orbit. It's just a lot of growth, a lot of promises, but a lot of challenges, right? The company has to meet these expectations, live up to them to earn that valuation and to excite people.
Bloomberg's Eric Johnson, who leads the team on space coverage. Thank you very much. And I point out, SpaceX hasn't commented on this. As it stands, Elon Musk has not posted on X about it. That's just the Bloomberg reporting. Let's bring in Phil Haslett for more. He's the Chief Strategy Officer over at EquityZen, one of the largest platforms for pre-IPO shares. There's a lot that you and I have to cover on a potential SpaceX IPO, which we've reported is for the entirety of the business, right? Not just Starlink. But actually, important to start with, you would note that SpaceX is the private company that users of your platform are most interested in. In quantifying that for us, just transparently explain what EquityZen's relationship to SpaceX's private market shares is.
Sure, and thanks for having me, Ed. Yeah, you hit the nail on the head. SpaceX is the most popularly requested private company on EquityZen. It's been that way for probably our entire existence as a business over the last 13 years. And that really just means that there is retail exuberance about investing in SpaceX. The company is 23 years old. It's older than a lot of my employees. It has garnered interest. It's had success. It's out in the public. People have done incredibly well with Tesla as public market investors. And so there's a lot of enthusiasm to invest in the company while it's private, and what seems to be now an opportunity to invest in it while it's public in maybe even less than a year, which is pretty surprising.
There is, of course, a lot that we don't know. What percentage of the company is SpaceX going to offer? What is the structure of the IPO going to be? But in reporting this story, Phil, one of the things I reflect on is that existing SpaceX shareholders aren't that diverse. You have Founders Fund, Fidelity, Google through Google Ventures and through Corp Dev, 137 Ventures, and then like others in the world of venture capital and strategics. But my point is that quite a lot of the company is owned by quite a small group, and then there's the Elon Musk factor as well. How does that translate in an IPO environment for anyone that wanted to get into the company?
Well, there's a couple other things to think about, which is that a 23-year-old company has had a lot of employees come, stay, leave, right? And so you have a wide swath of shareholders, kind of like a long tail of ownership. And so sure, there's some concentration in some of their biggest investors and in the founders' shares. But so this thing is pretty widely held. I'd go so far as to say that an IPO might also be a solve for the fact that the company is a private entity and can only have 2,000 shareholders. That is a requirement before they have to start filing financials. That may actually be a bit of a driver here as well. But as far as what the IPO is going to look like, this is uncharted waters, right? Saudi Aramco, Alibaba, those would actually be smaller than these IPOs, right? And we don't know, or than this IPO, and we don't know if it's going to be primarily secondary liquidity to existing, if it's going to be new capital, though I would posit it's probably going to be new capital based on a lot of your reporting as well, because there's going to be need to be investment from SpaceX into new computing and processing power.
So to a big portion of the Bloomberg Tech audience that work in the world of technology, tenders and the secondary market is something they'll be familiar with. Loads of people will not be familiar with that. And so what usually happens with a big IPO is in late stage growth primary rounds, where the company raises money, issues new equity, you get these kind of anchor investors that come in ahead of an IPO. It might be a year in advance. In this case, what we're reporting is the tender is confirmed. $800 billion valuation, $421 share price. Could you explain that dynamic? Ahead of a big IPO, how there isn't any new primary round, not raising new money, which, as you know, Elon Musk has been at pains to point out on X.
Sure. In its simplest form, if you're a business that's profitable and you don't need new capital to continue growing, why dilute yourself by taking in new investment injection, through a primary? A secondary liquidity offering is a way to reward employees or perhaps early investors by getting them liquidity for their shares without diluting ownership overall for everybody else. And this is something that SpaceX has elected to do over the past few years, I believe, kind of semi-annually, in a way to provide liquidity, not dilute themselves, also set a new kind of external price for their shares, but still maintaining an immense amount of control. And the only thing I would call out here, Ed, is that obviously $2 billion of liquidity is a big number, but it's actually only 0.25% of the valuation of this company. And so I hesitate to kind of identify that 800 billion is the new market price for SpaceX, more so that it is the market price that SpaceX has decided is out there.
Yes. Yeah, the tender was capped at $2 billion. That's what I reported. We just have 30 seconds. Valuation at IPO, $1.5 trillion. What do you make of that?
That, I think, would put it in uncharted waters, right? You've got 3 public companies that are worth north of $3 trillion. Where is the upside from 1.5? I'm not sure. At the same time, the bull in me says Palantir had a robust retail investor audience. It trades at north of 100 times revenue. So the art of the possible is somewhere in between those numbers. I do know that this would probably be literally the most exciting IPO we've ever seen.
Phil Haslett, Chief Strategy Officer at Equity Zen. Thank you very much. Coming up, Meta making moves toward a new AI model from open to closed. That's next. This is Bloomberg Tech. Meta's Mark Zuckerberg is shifting the company's focus toward a new artificial intelligence model that can make it some money. One new model is expected to launch next spring, potentially as a closed model that Meta can sell access to. This would mark Meta's biggest move yet away from open source models. The reporting comes from Bloomberg Tech's Riley Griffin. There's a case study. The case study is avocado. So let's start there. This is all what we're hearing from sources, but my understanding is originally avocado might have been an open source model. It's now not going to be based on our reporting. Take it from there, and then we'll get into the bigger picture.
Yeah. Essentially, Meta is working on this avocado model. That is the code name internally. And they have not officially decided whether it will be open or closed, but closed is the way they are leaning at the moment. And this is a really important distinction because it points to a monetization strategy. And as you know, Meta is under pressure to show that it can return on its multi-$100 billion investment in AI. And this is one path towards that.
There's detail in the reporting about how Alexander Wang, who's basically, the lieutenant leading the AI lab effort, is pro-closed model. In July, Mark Zuckerberg kind of told us why open source in this environment isn't that great. As the models get bigger, there are fewer people that can access them. It's a resource and constraint issue. But what else are you putting in the story here? Because, Meta was the sort of flag waver for open source.
Yeah, I mean, things we heard from in and around the company. For one, employees after July were told that they should not be talking publicly about open source as Meta reset its strategy. Remember, Mark Zuckerberg brought in all of these expensive researchers and had to reset after a very disappointing release of Llama 4. That was their open source model earlier this year. And so this is a resetting of the strategy under Alex's leadership with close involvement from Mark Zuckerberg, who sits quite close to Alex. And the pressure is leading to tensions, too. But that steer to employees internally to not be speaking publicly about open source should be a big tell.
The report is a must-read. Bloomberg's Riley Griffin with the reporting alongside Kurt Wagner. Thank you very much. President Trump decided to let Nvidia sell its H200 AI chips to China after concluding the move carried a lower security risk because the company's Chinese arch-rival, Huawei, already offers some AI systems with comparable performance. That's according to a Bloomberg source. Bloomberg Tech reporter Maggie Eastland joins us. Maggie, you and I broke this story together yesterday. As we understand it, right, the president was presented with a range of options from exporting no technology at all to the latest technology, and they landed somewhere in the middle. Take it from there and what else we reported and what we know about the Huawei Cloud Matrix 384 system.
Yes, one key detail we've reported is that this Cloud Matrix 384 system, which can link together hundreds of chips, was a key rationale underpinning the White House's logic to allow these advanced chips, which are better on a per-chip basis than what Chinese companies are capable of. However, as was made clear in our reporting, the White House is looking at this more at a system level, and their understanding was that Huawei's systems are actually advancing quite quickly. So that was the rationale here, and though this is a paradigm shift from previous administrations, during which Huawei's advancements were an impetus to actually crack down and further restrict those Chinese companies. Now that same evidence is being used as a reason to loosen controls and kick off this new strategy of selling Nvidia chips to China.
The main focus, as I understand it, is that H200 is 18 months behind Blackwell, generation to generation, and that's the comfort level this administration has. Nvidia's down 1.3% in the session right now. The other big report out there is from The Information, which reported that DeepSeek smuggled in thousands of Blackwell chips into China, getting them from countries of origin where they were allowed, dismantling the servers. Nvidia has come out with a statement, Maggie, pushing back on that report. Let's start with that Nvidia statement, please.
Yes, so Nvidia has said that these smuggling claims are a bit far-fetched in its own words, and while it investigates every tip it receives, it hasn't seen evidence of this. Now, one interesting thing from the report, Jensen Huang has said before that these Blackwell racks are just a bit too heavy to be feasible to smuggle, but this report from The Information did say that the smuggling for DeepSeek took place in these sort of 8-chip segments that could potentially fit in a suitcase.
Bloomberg's Maggie Eastland, who's out in D.C., covers the intersection of tech and politics with the reporting. Thank you very much. Another story, Amazon pledged to invest $35 billion in India over the next 5 years, boosting its spending in the key growth market to expand in businesses from quick commerce to cloud computing. The e-commerce giant says it will invest in areas such as AI and logistics infrastructure, and that the planned outlay through 2030 will help create an additional 1 million jobs in India. Okay, coming up, what to expect from Oracle's earnings report, which is after the bell today. It's a big one. We're treading water on the stock, but it's a wait-and-see moment. This is Bloomberg Tech. Oracle reporting earnings after the bell. This is the story. They expect on the street the backlog to grow. Remaining performance obligations, basically deals signed but revenue not booked, to continue pushing north of $500 billion. But Oracle's got a very big debt pile. And the one metric we're looking at, negative free cash flow, expected to be almost $6 billion in the quarter. Let's preview, let's discuss. Siti Panigrahi, Managing Director, Senior Analyst at Mizuho, covering SaaS, but also covering Oracle. This is the equation. We want to see growth in the cloud division, OCI in particular. But in the background, there's that stat. Oracle swinging to negative free cash flow for the first time since 1992. Remind us what your price target and call is on the stock, and then how you feel about that stat.
That's great. Thanks for having me here. Look, I think what you said right. At this point, investors are concerned about free cash flow. Mostly, they have to build massive capex build out for AI capacity, data center build out. And also they need to do the funding for that. So what matters at this today in the earnings call is Oracle giving some kind of clarity on that. Look, I think what investors missing is that Oracle has multiple options. They don't have to raise debt or capex. They can also go for alternative financing like vendor financing or capital leasing. Then you won't see that in a capex. But at this point, Oracle is not able to tell you how much will be capex or how much debt they have to raise, because they are going to evaluate this as they are building out data center, each data center. They are going to look at their own cost of capital and compare that with the leasing. So that's what I think one of the concern. We hope to hear from management on that, how they are going to fund the capex, how they're going to build the data center.
Right. I've been trying to learn as much as I can about how this world works, CT. Remaining performance obligation, RPO, is a term that gets bandied around all the time. But basically, it's a backlog, right, of business. Yeah. 500 billion as it stands. Yeah. As Bloomberg's reported it, quite a lot of that is OpenAI. Now, in the future, if something happens and a deal falls through, often in the contracts, there's some kind of penalty for cancellation or severance. But the question's still out there. How do we know that OpenAI in particular is good for it? That they'll be able to actually front up on the projects that they're committed to?
Yeah, I mean, that's a fair point, as you say. But if you look at right now, there are like handful of AI companies, like 3 or 4, OpenAI, Anthropic, Meta, and XAI. So Oracle got most of them, except Anthropic. So yes, and OpenAI is the trailblazer in that. So if they have that as a customer, that's, I think, most important at this point. To your point, can OpenAI pay or that contract will fall apart? Look, this is a non-cancelable contract, what Oracle says. So with that, and there will be demand. If we think about AI at this point, the rate it's growing, probably will need that demand at this point. But I think if you look at the concern, Oracle lost more than $300 billion market cap. You know, and OpenAI contract is only $300 billion. I think, if I remember, it's $322 billion market cap loss. So even investors are more skeptical beyond even OpenAI at this point, which we don't think, like, core business is still doing well. The way we are looking at it, you asked about the price target. I think if you are an investor, you need to believe on this long-term AI story. Growth is accelerating, $21 EPS they guided for fiscal 30. And if you discount it back, even applying 25 times, we get to this $400 price target.
Sidi, we just have less than a minute here. Do you like this co-CEO structure and the leadership of Oracle?
Yes, I think the way right now OCI is very important for Oracle. So that's why they're separating OCI. Because Clay is going to he's going to supervise, he's going to look at that business, and rest of the application and rest of the business, Mike Sicilia is going to do it. I think this model works. Larry's still there. He's the chairman. He's leading the group, leading the company there. So we like it. I think we'll see how it goes.
Oracle down 0.3%. We're treading water. That is the big earnings print after the bell. Siti Panagrahi of Mizuho. Great to have you on the show. Thank you. Now, coming up, Netflix is back to borrowing, and it's heavy. But now it has a stronger balance sheet to make the case. We're going to go back to the big Warner Brothers Discovery saga. Coming up next, we're going to get the analyst take, we're going to get the reporting, and then we're going to go bigger picture on what's happening down in Hollywood. Halftime. This is Bloomberg Tech. Welcome back to Bloomberg Tech. Probably the story of the week, maybe, has been the saga around Warner Brothers Discovery. 2 competing bids. One from Netflix, cash and stock at $27.75 a share, which is just for the streaming and studios, and one from Paramount Skydance, $30 per share for the whole enchilada. This is what those stocks have traded like on the week. We're not quite in the sort of discussion territory around arbitrage. In other words, looking at the gap between where the stock's trading and the price of the deals offered, because it's a live situation with multiple bids. But we are looking at the structure of the deals. Now, Netflix is looking to become Debtflix again. Do you see what we did there? After cutting back on debt during the pandemic, it's back to borrowing heavily to finance its planned acquisition for most of Warner Brothers Discovery, the caveat that they'd spin off the legacy network and cable lines. The difference is that now Netflix has a stronger balance sheet. Hot off the press, just hit the wire, Bloomberg's cross-asset reporter Emily Graffeo has the deep dive. Debt is becoming so important generally across technology. But in this case, with Netflix, it is a change of corporate policy in what is a potentially very big deal. What are you reporting?
It really is, Ed. So what we found is that this term Debtflix was introduced a couple years ago by some detractors when the company was rated high yields. They really built their business around borrowing heavily in the junk bond market. And some people didn't like how much cash the company was burning, but they've really turned that credit profile around now. So now the company's rated investment grade. That allows Netflix to tap into a deeper market, more investors here, and they have to raise a lot of debt to finance this acquisition of Warner Brothers. Bloomberg Intelligence estimates that right now they have about $15 billion of debt. That's going to about $75 billion, given the current terms here. But what we're hearing from a lot of different credit analysts is that Netflix has the balance sheet to fund this. So it's a turnaround story here. They are Debtflix. It's a fun term. I wish I could take credit for coming up with it, but I did not. But again here, it's investment grade debt, and it's debt that most analysts are confident Netflix can actually still keep that investment grade rating. And it can actually even potentially raise more debt if need be to top that hostile takeover bid because that balance sheet is so strong, Ed.
Bloomberg's Emily Crefeo. It's a must-read on the Bloomberg terminal. Netflix to Debtflix. Check it out. All right, let's bring in Laura Martin for more on this deal. There is a lot more to discuss. Laura is senior entertainment analyst at Needham & Co. It's one of these situations where there's the Wall Street view on this deal, the structure of the deal, and then there's the, what does this mean for Hollywood? And the reason I'm so excited to have you on the program is I think we could probably talk about both. But this is the first opportunity I've had to talk to you about two competing bids. I set the stage for it on Netflix's offer, cash and stock, and Paramount's offer. What is your position at this time, and what is your research into the competing bids?
So, I mean, I think the kudos have to go to Zaslav for creating this auction for an asset that's worth $12. We're now at $30 a share. And now we've heard over the tape this morning that both Paramount and Netflix have said they could go higher. So far we have a 300% premium over what the assets were trading at before the auction rumors. So first of all, kudos to David Zaslav and the Warner Brothers team for selling an asset dear. In terms of who wins, we are much more sanguine about Paramount's, or P-Sky is its ticker, regulatory ability to get it through the Trump administration.
Right.
We think that there are real issues with Netflix being successful, not only with Hollywood talent who see this as anti-competitive, I sit in Hollywood, as anti-competitive, especially because Netflix has said repeatedly it does not believe in the theatrical box office release window. And so all of Hollywood is scared to death that if suddenly Netflix owned Warner Brothers, that within 5 years they would stop releasing films in the theatrical box office, which is why we've seen pressure on the exhibitors also. So I think Hollywood is really negative, or let me say it this way, much more negative about Netflix taking over Warner Brothers than P-Sky. I would say that. And on the money side...
Let me jump in real quick on the money side. We will get to Hollywood, particularly technology, because Netflix's competency is the algorithm to an extent, and the library and the content. But I just want to go back and back to basics and what you said. $12 with Warner Brothers Discovery. You're not the first person to make this point, Laura, but just explain the basics to our audience, please. People do feel that the value of what either entity ends up getting may not be at $27.75 for the studio streaming, or $30 for the whole enchilada, as I keep saying.
Right. So, I mean, I'm comparing the trading price for WBD, Warner Brothers, for like a year. Essentially, it was falling, and it hit about a $12 price before the first rumor of a P-Sky bid started the stock moving up. And then I can't remember the Larry Ellison first bid or the David Ellison first bid, but now we're up at $30 a share for the whole thing, and that includes $27 from Netflix for studios, plus the idea is there'd be a $2, $3 stub left trading for the networks division, which would add up to $30 also. But in theory, so anyway, I'm saying we're like at $30 for the comparable asset that was trading at $12 before the auction began for this asset.
I think there's a lot of value in that answer, because the next question is, of course, about antitrust and what the combined entities would look like in either case. You said you believe, or you're more sanguine about Paramount Skydance combined with Warner Brothers Discovery. Why?
Okay, so in streaming, in the streaming industry, Netflix has over 300 million global subscribers and HBO Max has 150. So together, there's some duplication there, but let's just call it 450 subscribers, which is like 40% of the streaming market. Whereas Paramount, or P-Sky it's now called, has 75 million subscribers that you would add to the HBO, which is 150. So now you're at 225 million subscribers, much smaller market share of streaming than if you combine Netflix, which is the industry leader, with Warner Brothers HBO Max asset, streaming asset. So I would say that's one reason. And then the Hollywood studios, as you know, Netflix is one of the largest global creators of content, and you would combine it with Warner Brothers, which is one of the largest global creators of content. They have different windows, meaning distribution windows, meaning Netflix primarily creates for television, direct to streaming, the television screen, and Warner Brothers primarily creates content for both TV, but also the film business. It's a big film distributor. So I think the idea is putting these two huge content creators together would dampen competition for talent and lower prices for talent, and also raise prices for consumer. That is not a concern with P-Sky buying Warner Brothers.
Laura, we have less than a minute. Netflix would argue, and I am simplifying, that it would simplify it for the consumer. Having HBO Max, Netflix, people have multiple subscriptions. But it sounds like you don't think that argument will make traction.
Oh, no, it would simplify it for the consumer. But if they collapse, the thinking is they would collapse Netflix and HBO Max. Great. But what happens to the price? The consumer is going to get a much higher price if you add those two things together. So it's simpler. But really, monopoly policy isn't based on simplicity versus complexity. It's based on the price to the consumer and consumer welfare. And price is part of consumer welfare. Actually, simplicity is not in the laws as a driving factor, but price is. And price would go up for consumers if they combine those two assets, I think.
Laura Martin of Needham, it's great to have you back on Bloomberg Tech. I suspect we'll be talking about this deal for quite a long time to come. Thank you. Sticking with entertainment M&A, Disney co-chairman Dana Wollman sat down last month with Bloomberg's Emily Chang for an episode of The Circuit to discuss broadly the M&A landscape and what she thinks of the competition coming out of a potential merger. Listen to this.
I don't worry about a stronger competitor coming out of it because we already went through an incredible transformation in 2019 as Disney integrated the entertainment assets of Fox. We already went through, a big M&A event to expand our library, to increase the amount of IP that we ultimately could take over the top directly to the consumer. So I'm not worried right now. I also think whomever ends up in this situation acquiring WBD or any asset that's available, these are situations that require a lot of time. Time for regulatory approval, time for integration, time to figure out, how to combine apps, a lot of the things that we've already been through.
So Disney co-chairman Dana Wollman, along with Bloomberg's Emily Chang, again recorded last month. You can catch the full episode of The Circuit tomorrow at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg Television. All right, coming up, Elon Musk's SpaceX aims to blast into the record books with possibly, maybe, ready for liftoff, the biggest IPO of all time. That conversation next. This is Bloomberg Tech.
Getting good call-outs, healthy systems on the booster as it starts to pitch over the Gulf.
Okay, back to our top story. SpaceX shooting for the stars yet again, this time in the financial context. Sources tell us the Elon Musk-led space company well underway with plans for an IPO that would seek to raise far above $30 billion with a targeted valuation around $1.5 trillion. That would make this, by money raised, the biggest IPO ever. A representative for SpaceX didn't respond to my many requests for comment. Joining us to discuss is Will Whitehorn, chairman of Seraphim Space. Will was also former chairman of Virgin Galactic, somebody who's worked side by side with Richard Branson in the domain of commercial space. We have a lot to get to. Seraphim, an investor in all kinds of different space assets. And it's the space asset that I think is central to this SpaceX IPO story. My reporting is that they want to raise the capital for the SpaceX AI cluster, the SpaceX AI stack, space-based data center. Your reaction to that, Will?
Well, I think that's probably right. And I think that this is a seismic event for the entire space industry. We're not going to see the like of this. I think it's going to cause huge changes to the companies that are suppliers to SpaceX, to the whole massive kind of environment that they've created, particularly in the United States and in the UK, some companies. There's a company in the UK called Filtronic, for example, which has become a major supplier to SpaceX. Many of the companies in the Seraphim portfolio, they launch on SpaceX rockets. Starlink has obviously, when you link Starlink to AI, to data centers, you are seeing an entire ecosystem of businesses growing up. And many other constellations will benefit from this. There'll be in-orbit servicing, more data analytics coming out through the space industry. Space and AI will become interlinked in a way they've never been before. I mean, space really is going through a lot of change as it goes through this industrial revolution.
Will, we're going to question, report on, react to wherever the valuation of this company settles. My reporting, again, is that the target, based on what they want to raise, the percentage of the company they offer, $1.5 trillion. But macro, this is an industry, private commercial space that's growing. What is Seraphim seeing? What are the numbers that you're tracking on how an industry is basically growing out of SpaceX's wake?
Well, I'll give you an example. We've got one of the biggest companies in our portfolio. It's called ICEYE, which has this very special kind of aperture radar. The demand for it has gone through the roof. ICEYE's business plan has ended up being 2 years ahead of plan. They're in profit already, and they're just in the process of a very big fundraise. Other companies like Hawkeye 360, Satellite View, Allspace, all of these companies in our portfolio are all doing very well and getting ahead of their business plans very rapidly, because the demand for data from space is going through the roof for both climate change, defense, national security, communications. I mean, everything is relying more and more on space. And of course, as people get scared about the underground and undersea cables that supply the internet, the demand for internet data from space is starting to rise as well in the fintech sector. So everything is happening all at once. The insurance companies want space data because they realize it's more accurate than ground-based data for agricultural assets, buildings, infrastructure projects. So you've got insurance demand, agricultural demand, climate change demand, and now defense demand rocketing ahead since Ukraine and the Middle East happened over the last 3 years. And indeed, I got an OBE today from Prince William, which is one of the first in the space industry, to show that even royalty are catching up. And one of the first things he asked me was what I thought was going on in the space industry at the moment from the UK's standpoint.
Well, for our audience around the world outside of the UK, obviously I originate from the United Kingdom, an OBE, Officer of the Most Excellent Order of the British Empire. So congratulations to you.
Thank you.
Awarded to you this morning by Prince William. And I understand that you then ran to be here on the show, and that actually Prince William may be tuning in and a fan of the show anyway. Appreciate that.
That's true. That's very true.
I believe in transparency on this program. One thing that we should have done to start is, what is Seraphim's exposure to SpaceX? Have you any skin in the game?
No, we don't have a stake in SpaceX. Only a couple of British investment trusts do have stakes, both of them Scottish-based. Seraphim, when we started, it was too late to get into SpaceX at that time, which is a shame. But we have a lot of exposure to companies that I think are going to really benefit from this huge ecosystem of new investment that SpaceX will create. And I'm looking personally at other companies that will benefit. And in fact, I bought a stake in one today, which I think will be a beneficiary. This will have, as I said, a seismic effect on an industry already undergoing an industrial revolution. It is going to be, for me as an old hand, I mean, I'm 65 now, and, I was around in the days when the Netscape moment happened in 1995, which kicked off that range of internet investment that we still see today. And I think that this is the space equivalent happening right now.
Will, do you want to tell us what the company is that you invested in this morning?
Well, Seraphim doesn't have a stake in it. There's a company called Filtronic PLC.
Let me ask this then. You are 65 years old. Thank you for sharing that with our audience. Elon Musk is 54. He's committed to Tesla for 10 years. We just have 30 seconds. But is it realistic that this man leads two public companies at that scale for the long term?
Well, this is going to be a big question around the IPO, obviously, of SpaceX. Is he going to spend more time on SpaceX with this size of fundraise, or is he going to carry on in his Tesla environment as well? Both companies will be quoted. Both will be some of the biggest companies in the world. And you're quite right. This is going to be an issue that investors will look at very, very closely.
Will Whitehorn, Seraphim Space Chairman, awarded an OBE this morning by Prince William, then running over to the camera for us. Thank you very much. Now, coming up, Adobe reporting earnings after the closing bell today. The other big tech earnings that we're watching. Another stock treading water until we get there. That's next. This is Bloomberg Tech. Adobe set to report Q4 earnings this afternoon after the bell as the company looks to convince investors it is on the right track in the AI era. Bloomberg Intelligence says Adobe could see its annual recurring revenue target in the low double digits for 2026. Let's get out to Bloomberg's Matt Day in Seattle with the preview. Matt, what do we need to know?
So as Jefferies Brent Thill said, I don't know, the other day, low expectations and low investor interest. There's a lot of worries about whether Adobe, which has navigated the transition from packaged software to subscription software, whether they're going to be able to do the same in the AI era and survive all the newfound competitors they've got in the space.
That sets the scene. It sets the tone as well. I mean, I did a big interview with Adobe's CEO in the summer, and there's clearly a frustration. This is a stock that's down 22% this year, that they're not getting credit for the work they think they've done in AI. Part of it is how they sell it. Is there a bigger Adobe AI story that someone's buying?
There might be. They've tried to convince investors with a couple of metrics. One is sort of AI-first revenue. That's tracking at about $250 million. They've got another one, AI-influenced revenue, about $5 billion. But, as the stock price to date shows, investors aren't buying that all the way, particularly in a world where OpenAI is getting a whole lot of interest with Sora. Google's got new video generation models. If you're a creative professional doing something, that's Adobe's wheelhouse, and there's a whole lot of AI in the monitors right now.
I'm grateful you mentioned that, OpenAI in particular. The debate that Adobe's had, and maybe the shift, is they tried to pitch themselves as we have our own models with our own safeguards and data, and that's best for customers. Now they seem to be saying we're open to using other models and other data inputs as well. Have they kind of settled on their approach?
Yeah, it's a little bit of both. As you said, they definitely built their own models. They say they're copyright compliant, but just this morning they've out with a partnership with ChatGPT maker OpenAI to put Adobe products, a limited version of them, inside of ChatGPT. So they clearly realize they can't own the space entirely. They've kind of got to be everywhere that the users want to be.
Bloomberg's Matt Day with the Adobe preview. Thank you very much. That's a good way to end the show. That does do it for this edition of Bloomberg Tech. But I would remind you, it's not just Adobe out with earnings after the bell. Oracle's the big one, probably, that we're looking for. We expect a big backlog of business with a big debt pile that we're worried about. Those are the two names we're watching. In the show, it was all about SpaceX and an IPO we think is coming in the middle of next year. Recap that on the podcast. You know where to find it. On the Bloomberg platforms and online, iHeart, Spotify, and on Apple. From San Francisco, have a great afternoon. This is Bloomberg Tech.